So in this video, I'll be sharing with you some of the excerpts from the minutes based on the meeting that was concluded on the 1st of February. I have my notes right in front of me and I'll be using those as a reference. Most of the excerpts taken are those that I consider applicable to consumers, people like you and I, and how the Feds are actually looking at things. It's important to know how these policies are being made and what drove those policies. And that's why I'm sharing this with you. The first thing is, it's obvious that the Feds are aware that there are prospects for a downturn in the near future due to the persistent inflation. In domestic credit markets, the businesses and households continue to face elevated borrowing costs. And this makes sense because interest rates are being increased and the Feds are aware of these factors. Since interest rates on existing credit cards continued to increase in recent months, and interest rates on new auto loans also rose through mid-January. Credit remained broadly available for businesses and households with strong credit quality, but remained tight for lower-rated borrowers. And this is why it's very important that we work on our credit scores so that we are able to access credit when necessary. It's important. If you haven't seen my videos about credit score and how to build a credit score, you can always check that out. Credit availability for households with lower credit scores was considerably tighter, though comparable to levels prevailing before the pandemic. The HELOC balances at banks continued to grow, potentially reflecting homeowners using HELOCs as a preferred way of extracting home equity. This is important, especially if you have a mortgage and your interest rates is considerably much lower than what the rates that are being offered on personal loans are for now. So if you're thinking of getting personal loans, you might be better off tapping into your HELOC because of the lower rates that are offered on those, or at least the rate that you have will probably be lower than what you would be getting in the current market. In addition, the forward price to earnings ratio for S&P 500 firms remained above its median value despite the decline in equity prices over the past year. We know that most of the PEs in most valuable companies nowadays are exceedingly high, and in a normal economy, being too high is pretty much creating a bubble. And that's why it's important that this correction occurs. And by raising rates, those would impact the PEs as well. It says your household borrowing rose for borrowers with prime credit scores, but declined for households with lower credit scores. They're projecting the real GDP growth to slow this year and the labor market to soften. The level of real output was expected to move down to the staff's estimate of potential near the end of 2025. After that point on, the GDP should start to improve again. Now, when it comes to crypto, it's obvious that the Feds are not too worried about that because based on this excerpt that I have here, a few participants remarked that the recent failures of companies involved with crypto finance have had a limited effect on the broader financial system. If that sector collapses in terms of the crypto sector, for example, it will not affect the financial system of the United States, which is very important because that's why the Feds are there, to make sure that the financial systems are safe. Based on all of those data, it says here almost all participants agree that it was appropriate to raise the target range for the federal funds rate 25 basis points at this meeting. Few participants stated that they favored raising the target range to around 50 basis points. Now, this is an important point or important aspect of this because if you think about it, when it comes to the upcoming Fed meeting, based on the recent data that we received, which I'm going to cover here shortly, there's a higher chance that they will be increasing rates by 50 basis points. But let's continue. In support of these goals, members agreed to raise target range of federal funds rate to 4.5 to 4.75%. On that same day, February 1st, when this meeting concluded, the national employment rate in December was 3.3%, and it was down from 3.7% a year earlier. Now, why is this important? A low unemployment rate or a decline in unemployment rate means the economy is doing well and growing. On February 14th, the CPI came out and it was about 6.4%, which also meant that even though it went down by a point, there was a slight decline overall over the 12 years. It wasn't enough to appease a lot of these Fed officials. On February 15th, the job openings on the last business day of December, the number of job openings increased to 11 million, which means the economy is growing, businesses are hiring, and there isn't any much fear that the economy is slowing down anytime soon. On February 16, it says here, in January, a 1.2% rise in prices for final demand goods led to advance in the final demand index. And what this means is that there was an increase of about 0.4%. All of this points to a steady economy, although inflation is high, which is why the Feds are likely going to increase rates by almost 50 basis points in the next meeting. The next meeting is on March 21st and 22nd.